We cannot trust governments anymore. We cannot trust institutions with just blindly adopting their data sets or their manipulation of the data sets. In the UK, for example, a 30% loss in purchasing power. Why? Because the products that consumers spend their money on have risen by 30% in 5 years.
I identified some of the vulnerabilities that stablecoins faced in that era, which, that's what eventually led to Terra Luna's demise.
Do people really care about governance? Really? No, they care about money go up. Hey everybody, back again. Super excited today to be here with Stylianos Kampakis. And the founder is at the intersection between AI and blockchain, inventing a lot of interesting products, been in data science your whole career, right? But yeah, this is a show that we put on. Why? Because it's a super exciting time to be alive. There's so much change going on, so much innovation, and so much opportunity to really democratize everything and put tools into everybody's hands. And so I think those tools today are cryptocurrencies and the ability to build in decentralized environments transparently, permissionlessly, and get access to all of that. And then self-custodied. At the same time, all of this data, what is this data creating? What tools are being built around these data sets? What agents are going to help empower individuals? All of those represent great opportunities just alone around the topic today, not to mention healthcare, manufacturing, the building, and taking all the hard work away from humans and making machines do those while we can focus on the creative, the intellectual and cerebral part of the work and efforts that we're doing. And so much ado, straight into it, going over to you, Stylianos. Thank you for coming on. And yeah, maybe to share a bit about your background versus hearing it from me, a quick sort of overview on you and your background. And then what got you into where you are today around that blend between crypto and blockchain, Web3 and AI?
Yeah, absolutely. Well, very happy to be here with you, Stefan. In terms of my background, I've been in the space of AI and data science and machine learning since like forever. It's been more than 10 years now. I've been in the space of Web3 and tokenomics since 2017. I was one of the very first researchers in the area of tokenomics. Essentially, what I did is establish some of the basics in that area by using techniques I learned from data science and statistics and machine learning, and using them in token economics in order to study them and formalize them. And then a few years later, I found myself researching stablecoins around the algorithmic stablecoin era. And I identified some of the, let's say, vulnerabilities that stablecoins faced in that era, which, that's what eventually led to Terra Luna's demise. And what is very interesting is how crypto and as well as stablecoins have evolved in the last few years. So recently, by recently I mean the last 2 years or so, I've been working on Janus as a new generation of stablecoin and stablecoin development, borrowing ideas from tokenomics, borrowing ideas from AI, borrowing ideas from financial engineering and many other fields. I'm looking forward to today's conversation.
Yeah, it's interesting how you got into, tokenomics, right? I remember I bought my first Bitcoin back in 2012, and I liked Bitcoin because it had a limited supply, right? We had 21 million tokens coming into the market. You knew the halving schedule, you knew the block schedule, so you could forecast the tokenomics and the inflation across Bitcoin in Bitcoins over that period of time, right? And so Ethereum came along, and Ethereum had an unlimited supply. So there was no cap. And right away, you had the counter opposite to what everybody was buying into, ultimately changing the whole way that we were thinking about tokenomics. So there was the whole pre-mined tokens versus the mined tokens, right? And that led to a whole industry around tokenomics. How do you then programmatically put into smart contracts the emission of tokens? How do you define a growing environment and a burn environment, which Ethereum in the migration from proof of work to proof of stake managed to achieve, right? And you were in auditing. I saw you did a lot of auditing with Hacken, one of the most, sort of reputable auditors in terms of security audits with smart contracts. You were there helping with the tokenomics. How did you get into that space? I mean, did you have economics and maths as a background, and then you modeled out different scenarios? How did you look at the utility of a token? What were your first sort of 5 things to look at when you were looking into a token model or trying to dissect a token model?
Yeah, that's a great question. I think it's also a great, let's say, recap of the history of tokenomics. So I do have some background in economics. I do have a minor degree in economics, and I found it fascinating as a field. And I have done some work in computational economics, which I hadn't even really publicized before tokenomics. So around that part of my career was more focused on applied machine learning and computational neuroscience. But then when Ethereum became a thing, like you very accurately pointed out, token economies were created. And I realized that a lot of these theories and models I was looking at in computational economics could be applied in tokenomics. And I just started doing research in that area simply because I thought it was cool. And because it was very early days in that era, like no one really knew what they were doing. And there was a point in time where when you could Google tokenomics, my personal blog could be number one. And there was no one actually talking about it. It's crazy. And there's still some people who find videos I did years ago on things like agent-based modeling, which is now a standard tool in this area. And that's how I found myself doing some commercial work in this area and then doing more and more research. So at some point, I realized that the space had matured to the extent that it was no longer just about design, but it was also auditing. And I noticed this because in the early days, most of the clients that I had cared about design. But then a few years down the line, there were more inquiries around, I have built a token economy. Is it sound? Do I need to improve anything? And so on and so forth, which in traditional finance, we call this stress testing. Yeah. And that's when I came up with this concept of auditing. I published a couple of papers on the Journal of the British Blockchain Association. I've done a lot of work with Hacken in this area, like you very accurately pointed out, because I believe that smart contracts audits and tokenomics audits should go hand in hand. And this area looks like more and more promising.
Yeah, and so as you go down that road, right? I mean, it's really interesting how the token models have really evolved, right? I mean, from particularly around the ICO days with 2017, where we saw a whole raft of token models. And ultimately, what we also learned was there is a whole set of individuals that were not able to really translate and execute on those tokenomics and those token models. Ultimately, a lot of experimentation, and we learned a lot, right? What worked, what didn't work. We know the utility model, the governance model, and there were other reward models, etc. Right? And so as you look and we come into today, 2025, where do you see tokenomics moving, especially with the regulatory framework that we have today? What are your thoughts on how, is it governance tokens, right? I mean, do people really care about governance? Really? No, they care about money go up, right? So you look at then Hyperliquid, right? Their dividend, their revenue per employee, I think is like in the 100 million range, right? So it's like quite a significant numbers that you're seeing. Very different today. Is it a dividend? Will it be new shares? What is the new structure going to look like for tokens? What are your thoughts in that?
So I think tokenomics is evolving. There is obviously regulation that comes into play, but this is not necessarily something that's going to kill off tokenomics or innovation in this area. I also believe that there's other, let's say, areas of tokenomics that will always be very much alive, especially things related to stuff like Web3 gaming, maybe decentralized physical infrastructure, even RWA and things like that. So I do believe that things look promising. Obviously, regulation is going to have a very big impact on stablecoins, especially yield-bearing stablecoins. But regardless, I believe we're seeing, the space becoming more mature in a sense. So in the early days of tokenomics, we saw a lot of silly ideas where you could just do something using fiat currency, and then instead of fiat, you just use tokens, and the business model didn't make any sense. Then in DeFi, during the DeFi summer in the previous bull run, we saw a lot of very high APYs and things like that. And now we're seeing some new ideas emerge. So obviously, we're still seeing some nonsense, especially around meme coins and whatnot. But I believe this parameterization of pretty much anything that smart contracts allow is very interesting. So whether you launch a new token, whether you want to use it as just for utility within the platform, or whether you want to do other stuff like, I don't know, use some of the proceeds to fund charities or whatever. There are many interesting possibilities. I mean, I've discussed with many different entrepreneurs across the years. And then, it's really up to the market to decide who has the best ideas and which ideas stick.
Which one resonated most with you, or which sort of token model did you like the most?
Yeah, good question. So personally, I like token models that do not issue tokens for the sake of issuing a token, right? So I do like some utility. I do like some integration with the real world. Again, real world assets is a good example. Charities is another example. Some other type of physical good or service is a good example. I don't like governance too much, simply because even though in theory decentralized governance sounds like a good idea, in practice most people don't care. But I do like the idea that if you do something with the tokens, you have some kind of skin in the game and you get rewarded for it. So this doesn't matter what it is, right? But I do like this idea. It doesn't necessarily have to be staking, could be, but I think it's another interesting way to approach tokenomics. And then I do like also NFTs in areas like gaming, not so much around speculation. I'm not sure if we'll see a comeback in the NFT space. I do think we're going to see in certain areas, but most likely not in the same shape or form as we did before. So these are some of the things that stand out. What I don't like is some of the stuff. Obviously, I don't like seeing a token being issued just for the sake of issuing a token. I don't like also financial engineering, which essentially creates very high leverage positions and then hides them using jargon, which is something that happens in DeFi a lot, like huge APYs, and essentially you create a very elaborate Ponzi, which you just dress up with a lot of jargon, so it's not clear that's a Ponzi. And then you invite people to participate in it. So that's something else which I really don't like. So yeah, these I believe are the things that stand out.
Interesting. Yeah. I mean, I think, on that note, right, sort of the token models have definitely evolved. And you talked about earlier, right, where it's just for speculation. And what I always interpreted the tokens to do was allowing anybody to participate in venture capital. And as venture capital highlights, it's a highly risky environment, right? 1 out of 10 succeeds, and you don't know which one, right? You could invest all 10 be duds, but if you do careful due diligence and you really know the ecosystem, you understand the environment, and you invest in one entrepreneur out of maybe 9 others, right? So 10 total. You'll find that one entrepreneur that is passionate enough and persistent enough in a category that is likely to pick up, and he will ride with that wave that picks it up. You could make money, right? And I think that's how I always viewed venture capital. And you would, as a holder and an investor, be able to exit a lot quicker than your traditional venture capital industry, right? Venture capital, generally you hold on to equities through to maybe 7, 8, 12 years of a company before you can find an exit. In crypto, you found an exit within 1 year, in half a year, depending how quick you could operate. But the risk obviously is far greater the quicker you can exit, and you cannot prove your skills in executing on the vision that you have, right? And then the other downside or struggle a lot is mark to market. In a venture business, when you're private for 12 years, your mark to market comes every time you raise a new round, which is maybe every 2-3 years. In crypto, you're mark to market instantly, right? And so you are marked based on your performance, your sentiment, your goals, your emissions, the market environment, right? And so no matter what you do, you have to deal with being mark to market instantly. And that puts an additional burden on an early stage startup. And of course, everybody has an opinion. How do you deal with that as an entrepreneur, as an early stage startup, right? And I just find it really interesting that was one token model, right? Where the token was actually a representation of your participation. And you mentioned it earlier, I have skin in the game in a new model. And ultimately, there was a belief from a community in that model. And then they would, and if you could execute on that, that belief would retain, and you would then get stronger support for that retention and for that, sort of execution along the lines of your vision and the achievement of that goal, in pursuit of the goal. And it's hard to model tokenomics like that, right? It's really hard. And you look at meme coins, do they really have tokenomics? I don't think they have tokenomics per se. It's just, we believe in that community, and we will identify ourselves as penguins or cats or dogs or whatever it is, right? So how do you deal with that? So it's always interesting when a lot of people sort of suggest tokenomics. I still think it's not very mature. So I think there's a lot of room to improve the direction and the models around what is tokenomics.
So I guess there's quite a lot of things to unravel over there, right? So I think in terms of participation, I think there's and to counter, let's say, this issue in crypto, where the speed is just faster compared to traditional business. I think there's a lot of signaling that takes place through things like vesting and cliffs. So that's probably an important factor. But even then, not everyone is really aware of this, So when animal spirits take over during a bull run, not everyone is aware of these factors. And this is where auditing comes into play, which, again, auditing is not as mainstream to the extent that retail investors would look into a tokenomics audit, or look for a tokenomics audit in the same way that we look for a smart contracts audit. So I do think there's problems and there's solutions. I don't think the solutions are implemented per se. I mean, when I say the space is maturing, I'm not saying that even if parts of crypto are being institutionalized, it's still the Wild West in certain areas. And I mean, how can it not be when even traditional finance is the Wild West in other areas? Like, I mean, 2008, it's still something that happened relatively recently, in our history, and it was the Wild West for over-leveraged positions backed by property, right, and entangled financial system, and we're seeing like other issues now, like de-dollarization. I mean, issues in certain ways, right? We're seeing it's a monumental shift in the way global finance operates, as well as economics, because these two things kind of go hand in hand, even if they're often confused. And this is a confusion that also arises in tokenomics as well. So there's a difference between, let's say, the economy and as well and finance, right, and financialization. And I think in the West we often confuse the two in many different ways. And I mean, in tokenomics, maybe in crypto, that's again even more so. So and again, my aspiration through the work I've done in tokenomics is to try and standardize part of that field to essentially make the crypto space a bit safer, without necessarily compromising on the ethos of decentralization. But again, that being said, it's a crazy space. It's constantly moving. So even if we say, you have to abide by principles X, Y, Z if you want your tokenomics to be safe, it doesn't mean that next day everyone will just start designing the project in this way. So that's something to keep in mind.
I think definitely a lot of things to come in mind, and sort of it also comes back to one of the other things, right? I think with what you're working on with Janus DeFi, and the stablecoin environment has grown in crypto indigenously within the crypto community to a $250 billion industry, maybe 280 billion now, right? And now all of a sudden, we've realized that there is an amazing use case to have tokenized dollars, right? And so as that comes about, and this is likely an industry that's going to grow to $2 trillion in the next 1.5 years, right? So it's going to be a phenomenal increase in adoption or in supply. And how is that going to impact different protocols? And with a stablecoin, what is how do I participate in a stablecoin other than just having a currency? And I think you've come up with Janus DeFi with an interesting concept around inflation protected stablecoins. How do you see that, and what are the ways to participate in something like that?
Yeah, so the idea behind inflation-protected stablecoins is that you create an asset. So it goes back to the stablecoin trilemma, right? And one of the parts of this trilemma is capital efficiency. And many of the existing stablecoins are very capital inefficient in the way that they're over-collateralized, and nothing happens without collateral. So with stablecoins that bear some yield and they try to beat inflation, like Janus, the core idea is that you use some of this capital to generate a yield, but at the same time you relax some other assumptions behind the stablecoin, which kind of turns it not into a stablecoin, it turns it into like a soft stablecoin. Yeah, obviously this now with new regulations coming into play, this might generate other problems because it's kind of a middle ground between being a stablecoin and not being a stablecoin, which is obviously something, but this problem doesn't necessarily exist in emerging markets. Yeah. But going back to, let's say, designing an asset that's a representation of fiat currency, and I say representation because I don't want to say it's a stablecoin per se, because a stablecoin has to be it has to abide by a hard peg against a particular fiat currency, but you can have proxies of this, right? And or you can have a soft peg as we're using. So in that particular case, you open up a lot of possibilities if you start thinking in this way, right? So whether it's around generating yield, whether it's around having an asset which is more capital efficient or more robust in terms of, let's say, price fluctuations, or whether you want something that's more decentralized. It's obviously not, let's say, something for everyone, right? So I think going back to the fundamentals of designing these types of assets, there's always a set of trade-offs, like with all financial products, and depending on someone's risk profile and priorities, some products can be better than others. So what we're essentially working on now is creating a stablecoin factory, which will enable anyone to issue their own tokens. And the first thing that we're going to do is we're going to essentially launch Janus Alpha and Omega, which is the original Janus concept, just to prove how it could all work in practice.
Yeah, I mean, I think how to get it in. I mean, we work on Truflation, right? So we launched Truflation, and it's now quite a big signal in the marketplace. We've managed to break through the noise, and I think the world has come to realize that we cannot trust governments anymore. We cannot trust institutions with just blindly adopting their data sets or their opinion associated with the data sets or their manipulation of the data sets. And we did that for the main reason is to support blockchain projects with an economic indicator that really proves the development and the performance of an economy, right? And so why did we do that? It was mainly because fiat currencies or dollars or pounds or whichever country you're in are all dependent on a hidden tax called inflation. And over the last 5 years, we've seen in the UK, for example, a 30% loss in purchasing power. Why? Because the products that consumers spend their money on in order to put food on the table, to have a roof over their heads, etc., etc. All of those have risen by 30% in 5 years. And so what you're doing and what Nuon is doing and what Frax with their FPI are doing, or Spot and Ampleforth, are really trying to create this environment and this market where you have inflation protection associated with a stable coin, which is really innovative and novel. And I think the big question that everybody always has when I'm engaging with people interested in this product is, where does the yield come from? Where does inflation come from, right? So how does inflation get made? How do you make up inflation without risking losing everything, right? You mentioned earlier Terra Luna and stuff like that. So how do you deal with that?
Yeah, that's a great question. I think it's not easy. I believe that most of the projects revolve around the same ideas. So a lot of beating inflation within the context of finance goes back to generating yield of one form or another, whether it's in crypto or whether it's buying US treasuries, which is essentially still a bet that in the long run, at least that part of, let's say, the industry or the economy is going to go up, or at least you have a strategy. So if it goes back down, you can exit your position and capitalize on some of the profit. That being said, I believe that, and that's some of the things that we're working on in our design, I believe that the solution should also include assets in different areas of the economy. So I think real world assets can be a big one. Decentralized physical infrastructure can be another one. I just don't see a world where you can have intangible assets go up in value forever, especially in light of the fact that this is facilitated through money printing, and at some point the system might come crashing down. So I think a combination of some of the traditional strategies, but combined with real physical assets, is like an optimal strategy. That being said, maybe there's a counter argument saying that, look, you can find a middle ground in areas like gold or silver, so you might just as well use only gold or silver, simply because gold is such an established asset that maybe you can achieve the same or similar outcome, which it could be. So apparently there's an inherent risk in any of these approaches, because you're still betting on a long-term outcome. So that's like part of the system. You can get away with it. There's no world where there's like zero risk around any of these decisions. That being said, I do believe that some form of hedging, but not hedging within, let's say, the crypto space, but across completely different areas, is a very wise idea. And at some point, we do need to see, outside of stablecoins, outside of this conversation, we do need to see some part of the crypto economy landing back into the real world, because a lot of it for years is, it's been about building an amazing economy, but it doesn't necessarily do much. I mean, not all of crypto, but some of crypto, if you know what I mean. And even in cases where there might be some kind of soft utility, like gaming, and I say soft because it's not like, it's not, let's say, something as important as setting up a hospital. But even in those cases, we saw some ridiculous ideas like play to earn, where that would lead to token over inflation. And again, I felt this was kind of a wasted opportunity, a few years ago, where you do have something with tangible utility that is a game that people enjoy playing, and then you just overinflate your token, through this approach. And going back to the original point around stablecoins, yield-bearing stablecoins, and all that, I think right now we're seeing some early entrants in this type of space, and I guess all of them, they still follow the philosophy of coming up with one or two hacks to generate yield and promoting this as this strategy. I don't see a world where this can go on forever. Just create a product, and the product reaches a market cap of millions and millions and millions, based upon one or two strategies, whether this is like shorting Ethereum or buying US treasuries or whatever, because just having one or two strategies is fundamentally limited, right? So it can go on forever. That's why I believe running multiple strategies in parallel is the future.
Yeah, and you look at sort of these strategies, right? I mean, when inflation protected stablecoins came about, we were talking to them as flat coins, right? And ultimately, flat doesn't sound exciting. The community doesn't like flat. Who likes flat? We like volatility. We like mountains. We like curves. Sort of whatever it might be. But we don't like flats. But ultimately, the concept behind flat was, in fact, your dollar is declining in purchasing power. And so as a result, it's declining, whereas your purchasing power with an inflation-protected stablecoin stays flat and stays consistent. So that one egg that you could buy with X dollars at the beginning is still one egg with the same amount of dollars that you, maybe more dollars that you could buy, but the purchasing power of one stays the same. And so what happened then is people realized, I think, the term flat coin was not interesting. And so around came this concept of yield bearing stable coins, right? So ultimately I was earning yield on my stable coin. Because ultimately, stablecoin issuers, in order to issue a stablecoin, you give me $1, I give you a tokenized version of that dollar, which represents the equivalent of that $1. That $1 is put to work, as you mentioned just earlier, right? I am going to start allocating that in T-bills, in gold, in other assets to earn fees and revenue around that. And T-bills and bonds are viewed as pretty much equivalent one-to-one to a dollar. And so that ultimately that came about. And what does that mean for the category of inflation protection versus yield bearing? Would I not prefer yield bearing over inflation protection, especially if yield is always should be higher than inflation? And how do you see that sort of whole space planning out and playing out?
Yeah, I just think that there's probably no. You're absolutely right. I think there are probably some differences in the goals and the risk that someone would take in each situation. Because if you say our goal is to beat inflation, this is probably easier than saying we're gonna have the highest yield in the market. And even if you generate the highest yield in the market, if your goal is to beat inflation, then you're gonna approach wealth preservation in a different way, in a less aggressive manner, which is going to have the effect of reducing volatility as well as risk. So that's how I see it. So if you say my goal is to beat 2 or 3 or 4%, and then you generate a yield of 10%, then you're like, okay, so I generated more than I need. So maybe I can find other things to do with this capital. And you can start doing things like buybacks and all that to experience some kind of smooth appreciation. Why? Because again, you don't want to have a token whose price is going to be completely uncontrolled. So I think this type of idea of a flat coin or a yield bearing token is some middle ground between a stable coin and a traditional token that you wanted to 10x or 20x, which I think it makes for a great consumer proposition, maybe not for the most attractive investor proposition if your benchmark is like meme coins and NFTs from the previous run and all that.
Yeah. So ultimately there are two different types of investors, right? There's going to be a investor with a higher risk profile or higher appetite for risk, and then looking for greater rewards, but ultimately also possibly experience greater penalties. And I'm happy and comfortable to do that. On the flip side, I have a less prone risk investor that wants very low risk, stable income, secure. And ultimately, I'm happy with a lower return. And then as long as it hits certain thresholds with a much lower risk profile, right? I think the other thing is, we're talking about yield farming, securing yield, finding yield. A large portion of your work is also been in AI, right? Your background around data science, AI. How do you see AI and agents helping with identifying and spotting yield opportunities, or even coming in and supporting let's say, for lack of a better word, a GP, a general partner in a fund, to allocate funds into new yield bearing opportunities?
Yeah, good question. I think AI makes investing easier, right? If anything, you can just now go on ChatGPT and ask it to give you some investment advice.
Yeah.
So I can see AI agents doing the same thing. Now, whether you need an autonomous agent as such, or whether you just use AI within the wider scope of an investment system, that's more of a technical matter, right? But I do think they make things better in certain ways. Obviously, algorithmic trading has been around for a long time. I guess what's different now with AI is that it's just easier to work with. It's more accessible. You can
Yeah.
probably do a lot of things with a couple of prompts, whereas in the past you'd have needed to have a big data set and develop some complicated models. So I do think that's a very positive development because, going back to Janus, for example, with our stablecoin factory, we're integrating some AI capabilities. And an idea like this one we're just discussing now is going to be part of the overall design.
Yeah. I mean, I just see more and more, sort of agents sort of come into the play, right? Where you actually have access to all of these data. Most of the chains are now sort of indexed, if you will. You're seeing a lot, and
Mm.
they all should, and if they don't, they should have an MCP. What we've built at TRUF.NETWORK is all the data that's aggregated for Truflation is now, connected to LLMs through an MCP protocol, right? And
Mm.
so ultimately that allows LLMs to then really lean in and start learning about what the data is that's underlying, in this case, Truflation or other assets, and then ultimately be able to build agents using that
Mhm.
into for whatever purpose and service. And so in the fund management, that should also come about. And you're already seeing the ability to have agentic traders come in and do the trading for you, DCAing for you, automatically
Mm.
doing this. It's like, when are investors ready to maybe let go a little more and let agents take over, right? Yeah. What level of transparency and the thinking behind that do you think is needed?
Yeah. So in terms of transparency, good question. I think there's a lot of issues with AI and transparency, not just in finance or crypto, in all sorts of ways, right? And
Yeah.
some of it might be solvable, like which data sources is AI using to make decisions. Some of it is probably more difficult to solve, like how does it make these decisions? So I see more work being done in an easier let's say sub problem, which is how can we make AIs making the right decision, which you can solve some of these through self-reflection loops and additional safeguards, versus to actually creating fully explainable LLMs. Because I think the latter, that is creating LLMs which can explain everything around how they operate, requires some fundamental research and might take place through the big AI labs. I know they're looking into it. I'm just not sure when they're going to solve the problem. Now, obviously, this leaves us with some questions like there's a few nightmare stories in algorithmic trading about market crashes and whatnot. And someone might ask, are we going to see the same thing with AI? And the answer is, I don't know. It's possible, right? So I don't know what people are cooking out there. I don't know how this is going to create additional risks in the market. And I guess this gets us back, to a point we discussed earlier around flat coins, which again, they sound a bit boring as a term, but why would you want to prevent, like if you generate extra yield, why would you want to prevent a token from doing 10x, 20x? And this goes back into the fact that if something's overvalued, then it's quite likely it's going to dump at some point, right? So having a mechanism to absorb volatility in a way that doesn't necessarily strangle yield, it doesn't kill yield, can actually be a very good property. It can be a good way to, it's a very long term way of thinking, which and obviously in crypto doesn't happen as much.
Yeah, no. But I think, what, I don't know if you've seen this. This just came up the other day that we were looking at, which is, relatively simple AI trading bots naturally collude to rig Martin. So a Wharton, and I think it's a Hong Kong
Mhm.
Science of Technology University, yeah, here, UST. They put together a report in terms of how to get AI agents to trade and then to collude to around moving a price up or down, and then another bot coming in to take advantage of that collusion and mistakes around that. And to me, that was really an interest. And they documented a lot of this in a nice report. So it's public, right? AI powered trading, algorithmic collusion, and price efficiency, right? So ultimately, these AI bots are beginning to take market making roles in opportunities, which then allows for multiple different protocols to leverage and identify, agents to really help structure and secure a yield opportunity, right?
Yeah, and I think this is
And
only
automatically do that.
yeah, and this is only the start. Like
Yeah.
actually, no one knows how these agents would interact with each other. No one knows that. So that's why it's probably good in certain ways, if you care about stability, to be a bit defensive. As I mentioned, we had seen like flash crashes caused by machine learning trading bots. So we might see something similar with AI. Now, I hope. I mean, no one knows. We're not going to see, like, talk about collusion of AI agents, any type of crazy scenarios where they collude to do all kinds of crazy stuff, mimicking like human free will and whatnot, right? Again, that's an active area of investigation. So you kind of, these systems, they need to be very constrained, I believe, in the way they operate. They need to be very, very, very constrained. In the very least, given that you don't know what other participants are doing in the market, you have to take this risk into account yourself, right? And you have to be maybe somewhat constrained and with it, in terms of the assets you interact with and whatnot.
So how do you see, sort of as the agentic world starts to rise a lot more, right? And in this world where you have market makers, you have traders that are agentic, how do you see the evolution of especially with sort of info finance or prediction markets, that will we see agents sort of see there's a gap here? I don't have enough information or knowledge around this data set for this product to move. Let me go and create a market and see how the relationships are between that market and the price of the former market that I want to get more insights into. So you will see the creation of new marketplaces, and then ultimately agents, because they see an opportunity and manage to correlate and find pricing opportunity, will start trading in that. So we'll see a whole bunch of new markets being created and trading volume in the long tail associated with those new markets that are created. How far away do you think we are from a world like that, given what you're seeing and the world that you interact with a lot?
Yeah, very good point. I think the best. I think it's best to figure out how to use these types of things to your benefit, instead of creating risk. So, for example, prediction markets can be a very powerful mechanism. So, for me, again, going back to Janus, the question is, how could you use, for example, a prediction market that uses agents as well as human expertise to extract information about externalities, for example, which can impact the project in a negative way. Yeah. Now, in terms of speculation, there's going to be a lot of that, right? There's going to be a lot of that. In terms of noise, definitely there's going to be a lot of that, right? So what happens if all the agents or most agents revolve around the same 2, 3, 4, 5 LLMs, and they just kind of keep repeating like the same thing, So probably prediction markets might have to evolve to place greater emphasis on humans, or that is knowledge that humans possess, as opposed to AI agents. Because look, where AI has a benefit is when it needs to consume large amounts of information which are available online. But where humans have an edge is around absorbing information from the real world, from real conversations, which maybe some of this information can be found online, or maybe it may not. And I'm not talking about insider trading. I'm talking about everyday conversations, or going to a conference and checking out the vibe. And this is where prediction market gives someone the ability to they incentivize essentially sharing this type of information in a very particular sort of way.
Yeah, I mean, I think it's really going to be an interesting time where, I mean, ultimately, the way I see sort of Janus DeFi, right? I have a US dollar or USDC. I give you my USDC. In return, I get a Janus token, right? What happens with that USDC? How much of the work will be done around that USDC? What work will be done? Who is going to be managing the work associated with that, right? In the case of Ethena, they're putting it into ETH, right? You give them ETH, they're getting yield off that ETH. That yield gives them ability to trade off the back of that. So, but actually they're people doing that, and maybe they're automating that, and maybe that becomes more agentic, right? So in the case of Janus, will we see more automated solutions around going screaming through cross-chain opportunities for yield in different pools, different farms, so that stablecoin can go to work, right? And we're going to see much more of that as we see the stablecoin industry grow, at astronomical speeds over the next 2 years.
Yes, so we're going to implement some of that in Janus. Again, we're going for a human and AI approach. So essentially, let's say in terms of yield, right? So at some point, we want to open up yield generation to anyone to propose their own strategies, and they can also use AI. But we don't necessarily. I mean, and also the plan is to at some point use the AI like a governor. But before we get there, well, we're going to have this human component, and maybe this is always going to be there, where a human needs to have some skin in the game through tokens, right? Before they release an AI. So I think a lot of it comes down to game theory and incentives. So ensuring that there is access both to the upside and the downside, for an individual participant. So it's not only the protocol that has full ownership of that part of the equation. So also you see that I'm thinking more in terms of systems and game theory, simply because I don't want to say, hey, we came up with an AI hack and we can generate infinite yield and that's just the end of it. Because even if you had access to this type of hack, it's going to be short-lived, So what essentially ensures the longevity of a token economy is having the right incentives in place, the right game theoretic incentives, which make sure that everyone's incentives are aligned.
And so what we've been talking about in the past is also we've been working on this project around flat coins, and we realized, and that's sort of why we know a lot with Nuon, right? So we realized that flat coins are just not exciting, especially in bull markets where yields in crypto land are much greater and higher, and people can go and attain those themselves. But what we did find is there's a huge opportunity around the stewardship or the governance associated with the dollars there, right? Agentically or humanly, how do you manage those funds? What's the strategy around that? And ultimately retain the transparency associated with that yield acquisition, right? And the allocation of the fund. So the user has constant insight, or the holder of that flat coin or inflation protected stable coin has total insight into how the funds are allocated. And ultimately, hopefully that creates a certain level of trust.
Yeah, you do need to be more transparent. I hear what you're saying. So in our case, before we launch our actual tokens, we're going to launch some sort of stablecoin factory, and we have a Lego blocks approach, right? Which essentially entails that with the Lego blocks, you can pick and choose different mechanisms, different ways to do things. So this is going to be some kind of self-drive to figure out which mechanisms work well or do not work well before we actually launch our own tokens.
Yeah, so you want to see before, so prove it out, define the model before it actually launches the own token, right? Which is, I guess, coming back to your experience in tokenomics and under sort of trying to identify a model that actually resonates with the user base and that makes economic sense ultimately to convert into a token on how to manage the protocol.
Yeah, exactly. And I guess there's also other issues like the regulatory issues. So the thing is, we're in an interesting situation where I think we've nailed down a lot of the theory behind these types of assets, but we don't really feel that we want to necessarily make a super long-term bet on one type of asset, one particular instantiation of these assets. That's why we went up the abstraction layer and said, let's focus more on this factory approach, while at the same time keeping everything else we've designed so far, but for a later date.
Yeah. I mean, one of the things is also I noticed that you launched a sort of, I want to call it a university, but it's not quite a university, an academy maybe is the right word, Tesseract, right? Share a bit about that and what's the purpose of that? Why did you set that up?
Oh yeah, Tesseract Academy has actually been going on for like close to 10 years now, right? So it's it's an executive education consulting company focused on AI and Web3, and primarily helping professionals that don't have technical expertise. So there's also a free course in tokenomics for anyone who wants to join and take a look. Some introductory courses on Web3, as well as AI for managers and senior professionals. And again, my whole career has been, or a large part of my career has been, about simplifying tech, explaining tech to people that are getting affected by it, or they want to use technology, especially AI and Web3, but they don't know where to start from. And this is what Tesseract Academy is about. It's about helping really professionals make the most out of technology. And I think with the current pace in terms of all the things we're seeing in crypto and AI, this becomes more important than ever.
Yeah, I mean, I think, what's your view? I mean, are people really nervous about AI? Are they more willing to lean in? Somebody was telling me that people worry that if you say you use AI, that they think that you're 10% dumber or something like that. What's your perspective on that? I mean, I had to laugh at that. I just thought, wow, that's a real interesting perspective that I'd never heard.
Yeah, I think it just goes back to the fact that if you use any tool, you become, let's say, more productive in ways, but then you lose the capability to think without that tool. So I think the best example of this is Google Maps. I'm pretty sure that the new generations, they don't really know how to use a physical map. And I feel this is like a great example of that, right? So I guess there's the fear that if AI does everything for us, people will lose all kinds of basic thinking capabilities. I'm pretty sure there are a lot of people who can do basic arithmetic because of the use of a calculator. And with AI, people may not even be able to articulate a proper sentence with grammar and syntax without requiring an AI to essentially improve their English in the sentence. So obviously, some of these risks, maybe they're a bit overstated and stretched, but still, I do think it can be an issue.
Yeah. I mean, I don't know. I've always been a believer in leaning in, right? We used the calculator, we used the internet. It didn't make us dumber. It made us a lot smarter. It gave us access to a lot more information. I think it's really how open we are to new technologies. And across the board, right? I mean, I think we are in a world where technology is abundant and it's really helping us in so many different facets of life. And I think we're still at an early stage of all of the innovations that we're going to be experiencing throughout the next decades, centuries to come. So anything. So how can people get a hold of you? What should they follow? We talked about Tesseract, we talked about Janus, we talked about your work in tokenomics. How do they follow you? And stay in touch with you?
I think LinkedIn, right? That's the easiest way. Just ping me on LinkedIn. I'm quite responsive, and we can take things from there. Yeah, I'm involved in a few different things. I always check my LinkedIn quite regularly. So if anyone wants to get in touch, my name is quite unique. Just Google my name. You're going to find my LinkedIn and drop me a message. And I promise I'm very friendly.
Okay, well, thank you, Stelios. Lots of interesting insights, lots of interesting work that you're doing. Look, I'm going to be in London in the next week or two, so I will look you up as well. So thank you very much for your time, and look forward to meeting again and seeing you in person.
Thank you. See you soon.
Thank you. Thank you, Stelios.